It seems you can't watch a news broadcast today without hearing about the ups and downs of the financial markets. Sometimes the slightest news event in the farthest reaches of the world can send investors into a spiral of selling or buying. The volatility of the financial markets is something that should interest all business people as well as those seeking to diversify their portfolios of investments. The reason is that when the market is on a roller coaster ride, business owners who often have stock portfolios as a cushion for downtimes start conserving their expenditures, which then affects the revenues of other companies, such as advertising firms that provide products and services to the business. The financial market, in which securities are traded, such as stocks and bonds, is divided into two segments: a secondary market, which consists of existing securities; a primary market, which consists of new securities created when companies seek investment capital in exchange for equity in their companies. Within the secondary market, you find the major stock exchanges that you often hear about in the news: the New York Stock Exchange, NYSE, the American Stock Exchange, Amex, the Nasdaq stock market, the Tokyo Stock Exchange, TSE, and the Australian Securities Exchange, ASX, to name just a few. You also find dealer or over-the-counter market, OTC, where securities are not listed on an exchange but are traded through a network of middlemen and numerous futures exchanges for trading commodities such as crude oil, soybeans, and gold. A stock is essentially an ownership interest in a company that may be private or public and listed on one of the stock exchanges. Owning stock is a way to participate in the economic growth of the nation as well as the global economy. Purchasing stock traditionally is a great way to hedge inflation and achieve good returns on investments over the long term. Two basic types of stock exist: preferred and common. Each is quite different from the other, so it's important that you understand these differences before you purchase. Preferred stock. In general, preferred stock doesn't carry voting rights in a company, but it does have a guaranteed dividend or payout, usually quarterly. That's a percentage of its par value. That guaranteed dividend is what you receive for giving up voting rights. Par value is simply the face value of the stock at purchase or at the date at which dividends are declared. Common stock. Common stock is the basic form of ownership in a corporation. No corporation can exist without it. Common stock has what's known as a residual claim on the assets of a company. Residual claim means that common stockholders get paid after all other claimants are paid. Consequently, common stock is more risky than preferred stock, but the shareholder's liability is limited to the amount of the shareholder's investment in the company. Common stockholders enjoy cash dividend rights and voting rights, and they may also benefit from stock dividends and stock splits. With a stock dividend, the company issues stock rather than cash, usually as a percentage of the shareholder's existing shares. For example, a company may issue 0.08 shares for each share an investor owns. In a stock split, the percentage increase in the number of shares you hold goes up by more than 25%. One reason companies choose to do stock splits is to keep their per-share values at a level most investors can tolerate. It's conceivable that if a company didn't split its stock, the price could go beyond the affordability of most investors. A stock quote is simply a listing of prices for a stock at a specific point during the trading day. It provides the basic information you need to check on the status of any stock in your portfolio. The quote also displays a graph of the previous 10 days of stock value. The graph indicates a lot of movement in the stock price on a daily basis. The P/E ratio, price per earnings, which is the market value per share divided by the earnings per share, typically reflects the company's last 4 quarters of earnings. A high P/E ratio normally forecasts higher earnings growth in the future, making it a good way to compare one company with another within the same industry. Sometimes called a multiple, the ratio tells you how much investors will pay per dollar of earnings. Remember, when investing, don't ever make a decision to invest based solely on P/E ratio, because the figure is only as good as the basis on which the earnings were determined. You need to go back to the financial statements to check how earnings were calculated. The P/E ratio is just one metric to consider before making a decision. Everyone has an opinion on the best way to pick a winning stock. This section explains in detail 3 popular strategies for picking stocks: value investing, going for dividend growth, and picking businesses you like. Value investing. If you're the kind of person who never buys a new car so you can avoid the immediate depreciation in value as you drive it off the lot, or if you're the kind of person who spends hours looking for the best bargain, value investing may be for you. Value investors in the stock market look for cheap stocks that don't make the news because either everyone has left them for dead or they're just not sexy enough. Well, some cheap stocks may make the news if they're particularly bad, but for the most part, you'll find these stocks by looking for ugly, boring securities with low price per earnings ratios, less than 10 times earnings during the past year. You also can discover them by looking for stocks that the analysts aren't crowding around. Deciding when to buy is more art than science. But if you determine that a stock is a great buy at 10, you can deduce that it's an even better buy at 8. With a great stock, you should buy more as it's going down and sell off when it goes up past your lowest average cost. Unfortunately, most investors do just the opposite. They sell off a good stock as it's going down in price and buy as it's going up. Investors seeking dividend growth aren't interested in the current yield on a stock. They're more interested in finding companies whose dividends increase on a regular basis during a long period of time. Rising dividends often are the signs of a successful company because you need excess cash to distribute dividends. A regularly rising dividend may indicate a friendly and somewhat stable business environment, a very positive indicator. Of course, you don't want to focus on growing dividends in a vacuum. You also want to look at a company's P/E, price per earnings ratio, to make sure that it's in line with other companies in the industry. The P/E ratio is the ratio of the price of one share of stock to the earnings per share of the company. It's a multiple such as 5 or 10. If a company you're considering for investment purposes has a multiple of 5 times earnings per share, while similar companies in the industry have multiples of 10 times earnings per share, you may want to do some further investigation to find out why such a discrepancy exists. A mutual fund is a portfolio of stocks that's managed by a professional company. Investing in a mutual fund is a way to avoid the risk of picking individual stocks. The fund manager's strategy for selecting stocks depends on the goal of the mutual fund, growth, annuity, and so forth. But in general, the manager wants to spread the risk over a fairly large number of stocks so that a loss on any one stock does not significantly damage the return on the entire fund. Mutual funds are also probably the safest and least costly way to invest in lucrative foreign stocks, which have different fee structures and reporting requirements. Mutual funds are very popular investment vehicles for several other reasons. Finding the best mutual fund is now easier because many publications in print or on the internet are evaluating various funds and giving advice to consumers. You can rely on the expertise of a professional money manager hired by the mutual fund. You can achieve a diversified portfolio, one with a variety of different types of stocks and bonds, in other words, with relatively little money. Although you may not beat the averages in the short term, you'll do well over the long term. One substantial disadvantage of mutual funds has to do with the associated tax implications. When you invest in mutual funds, you receive an annual statement of investment gains in the form of income and capital gains distributions, as well as a report on any dividend distributions, which are taxed as ordinary income. Whether or not you reinvest these gains, you have to pay taxes on them, and it's difficult to know in advance how much you'll be liable for. If you invest in individual stocks, on the other hand, you can decide when to take profits and when to pay taxes on them. Decide which types of funds you want to own. Among the many choices are a single broad-based fund that buys a variety of different types of stocks and bonds, specialized funds, for example, high-growth funds, foreign stock funds, an emerging market fund that focuses on new markets and newer companies. The choice of fund will depend on your financial goals, how old you are, and how much you have to invest. Identify the costs associated with the fund. Recognize that foreign stock funds generally have higher costs, for instance. Don't choose funds that have costs higher than industry averages. Look at what other funds of the same type are charging. We also suggest you look seriously at no-load funds. These funds charge no sales fees and don't use brokers to deal with the public. All your money is invested in the fund. Consider the risks associated with the fund. With a more diversified stock fund, you can better manage your risk. You can even choose funds that invest exclusively in more conservative stocks. Look at the fund's track record. Be sure to compare apples to apples. Foreign stock funds with foreign stock funds, for instance. Also, make sure that the overall performance figure of the fund isn't based on 1 or 2 years. A good fund has consistently performed well over a protracted period of time. Find out who's managing the fund. Every fund has one person who's a key stock picker. Make sure that this person has a successful track record and plans to be around for a while. Mutual funds aren't perfect financial vehicles for investment. They often underperform the market while demonstrating fairly erratic performance behavior in general. Nevertheless, if held over a long period of time, say 20 years or more, with regular investment, they'll typically outperform most professional investors. The key is holding them for a long time. Bonds are debt securities where the issuer of the bond promises to repay the holder of the bond, you, the principal, what was borrowed, and interest at some future date. Unlike stock, the bondholder doesn't have equity or an ownership stake in the company or governmental agency that issues the bond. Basically, 3 types of entities issue bonds: the U.S. government, corporations, and municipalities. U.S. government bonds. The U.S. government is the largest debtor in the world. The government borrows more money than anyone through 2 types of debt instruments: Treasury debt and federal agency debt. Treasury debt. We assume many of you have purchased Treasury bills, T-bills, notes, and savings bonds. They're all debt instruments, but they differ in their maturity date. If you look at the returns on bills and bonds over a long period of time, you find that Treasury bill investors have never lost any money because the government typically pays these on time. On the other hand, those who have invested in Treasury bonds have experienced a loss in a given year, even though the government actually paid the bonds when due. What this means is that in a year with a loss, the decrease in the bond price was greater than the interest income the investor received. You can find out what the various Treasury instruments are paying by looking in the financial section of a major newspaper, such as the Wall Street Journal or the Los Angeles Times, or by going online. Corporate bonds. Corporate bonds are the smallest sector of the bond markets. This type of debt is issued by large corporations that promise to make payments to the bondholder over a period of time. In this type of investment, it's important that you check on the corporation's ability to repay. You can do this by looking at the Standard & Poor's or Moody's bond rating. The rating should give you an idea of how much risk you're facing. Municipal bonds. Municipal bonds are issued by governments and governmental or quasi-governmental agencies that aren't at the federal level. The important thing to know about municipal bonds is that they're exempt from federal income taxation, which makes them very different from other types of bonds. Because they aren't taxed, municipal bonds are most valuable to investors who want to enjoy that extra benefit from a bond investment. To give you an example of the benefit, it's possible to achieve the same after-tax return from a low-yield municipal bond that you do from a high-yield taxable bond. When you compare bonds that have the same interest rate and maturity, you should choose the one that has the highest after-tax return. Bonds generally come in two flavors: pure discount bonds, also known as zero coupon bonds, and coupon bonds. The difference is simple. Zero coupon bonds make no payments to the holders between the dates they're issued and the maturity dates. In other words, you get nothing until the end. Coupon bonds make a series of equal payments throughout the life of the bonds, so if you are looking for an annuity, this is the way to go. As soon as a bond is trading in the bond market, its future payouts are decided, and the only thing that changes is the asking price. Your yield to maturity will go up if you can buy the bond at a lower price because bond prices and yields move in opposite directions. The amount that a bond pays at maturity is called its par value or face value. The discount amounts to the difference between the selling price of the bond and its par value. Whenever you're dealing with financial assets, such as bonds, you need to understand that the price of a bond is equal to the present value of any future cash flows generated by the bond. A zero coupon bond has only one cash flow, the payment made at maturity, so the price of the bond is the present value of its face value. Coupon bonds typically pay out semi-annually in addition to paying the face value at maturity, so the value of this financial asset is based on the sum of the present value of all payments until maturity. Bonds are rated from AAA to D, depending on the rating agency. In general, a bond that's rated A is the most secure, given whatever fluctuations may occur in the economy. If your bond is rated in any of the B categories, there's a chance that your issuer may default on the interest payments. Bonds rated below BBB are called junk bonds and are pretty precarious investments for the average person. The two major rating agencies are Moody's and Standard & Poor's.